Gabriella, does this, how does this make you feel in terms of telling clients how to prepare for the next 6 months or year?
So it really emphasizes our message that it's still too early to be adding risk, still too early to go all in, chips on the table. So we would still be underweight equities versus bonds, underweight credit versus high quality fixed income, because ultimately we're still seeing a lot of uncertainty around the future path of inflation and ultimately what that means for where real rates settle, where all asset classes seem to be taking their cues, including equities, credit, FX. So I think the data this morning just emphasizes that we're still seeing the early days of a deceleration process in inflation with very mixed news, as Steve went through. There is some good news. There's some deceleration in goods prices, some improvement in supply chain issues, mixed news around commodities more recently, with a slight rise in energy prices once again. And then some still bad news in inflationary pressures in services, as well as in a component that's not included in the PPI, but it's important for the CPI tomorrow, which is everything around owner's equivalent rent, which is the biggest component of CPI. So we're still very much early days here of the decelerating inflation. Still keeps a lot of uncertainty about when the Fed can decelerate, when it can pause, and never mind when it can start cutting rates much later on.
Stephanie, the Fed looks like they're smart, for talking tough and it's going to last and everything. Do they have any inkling about what these numbers are going to be, do you think?
No, they don't have a lot of credibility. They were behind the curve. They should have been raising rates a year ago, and they were buying bonds in March, Joe, as you know. So, I mean, they're way behind the 8 ball. I step back and I look at these numbers, and fine, maybe we're kind of peak-ish, but we are at huge, huge levels. 8.5% in the PPI and 7.2% in core. And I sort of kind of ignore core because I think food and energy are a big problem, and I think it's going to be very hard for the Fed to get these numbers down. So basically what this reinforces is what we've been hearing and seeing. Inflation is high. The Fed is going to be hawkish. They're probably going to overdo it. We don't even know what the impact is right now from all of the rate increases. And we're not going to feel that until sometime next year because there's a lag impact. So 2023, likely recession, rates stay high for longer, and we just have to buckle in.
All right. You're not going to sell anything today, are you, Stephanie?
No, I'm not. And I'll tell you, I am very much looking forward to earnings. And I know we're going to talk banks on Friday. I'm looking forward to that. I was very excited about Pepsi. I mean, that was a really, really impressive report today. And talk about, input costs. They're at the forefront of that. I'm not going to sell because we're already down 23% in the S&P year to date, and sectors and stocks are down. Many of them are down much more than that. So I am looking for bargains. Market's a forward-looking indicator, so we're already discounting a lot of the stuff for next year. But that being said, I kind of think we're in this trading range. So there's no real rush, but I do have dry powder so that I can add on some really ugly days.